is that like your like official name, Tim? Or is it like Timothy? What's your actual name?
My middle name is T-E-N-G.
Oh. Did your parents ever tell you why Tim? Did they see it like Home Improvement or something?
Well, not really.
Oh.
It's a very simple name, very easy to remember. But good to see you. How are you feeling? You feeling okay? Okay.
I just can't really hear too good with my right side.
Okay.
Got like stitches in my mouth.
Oh my goodness. Yeah. I'm sorry to know that. Yeah. I mean, it's good you're here.
Yeah, exactly.
Yeah. Yeah, you're eating well. I don't see anything on your face.
I look really nasty like a week ago, but I don't know.
That's definitely good. Okay, I think we can get started. This is our short-term plan. Today we're going to be talking about two in-class examples. It's going to be very important because one of the questions is exactly the same as homework question, right? The straddle portfolio using options. So this is our short-term plan. We are here right now. Okay. So we're going to wrap up chapter 7. We're going to wrap up the discussion of option contracts, call options, put options, how we use options in the portfolio. Today, let's get our hands dirty. Let's work together. We have two big questions to talk about. One is for speculation. The other one is for hedging. Okay, so in the hedging question, we're going to see that later. We don't care about returns. We don't care about profits. All we care about is removing the risk, sort of it's completely for hedging purposes. So those two questions we'll be talking about today are very different, but the main core thing, value, is how we use options to achieve different goals. Okay. So this is today's plan. After today's discussion, we'll be able to wrap up chapter 7. And then moving onward, starting from this coming Tuesday, we're going to talk about homework questions. Okay, so you can feel free to come here. I'll be here during our regular class hours. We'll be walking through, the 4 base calculation questions to see if you have any questions. Okay. I'm going to give you a main idea, some hints regarding how to solve for the arbitrage pricing theory question. And also the option question is going to be exactly the same with one of the questions we'll be talking about today. And also for the option portfolio hedging question as well, which is number 4, the very last calculation question in the homework. Okay, so we'll be talking about those questions. If you have any questions, it's going to be a good time for us to discuss, to talk, and you can feel free to ask me about any of the multiple choice questions this coming Tuesday. Okay. So Tuesday is going to be a homework sort of review tutorial, but I'm not going to give you the final answers to any of those questions. We're going to go through the logic, the main steps. Okay? And then the homework is going to be due on the same day, 21st, on that Tuesday at 10 p.m. But you don't have to wait until the very last minute. You can submit the homework on the platform, on Canvas, anytime, whenever you're ready. Okay? And then that's pretty much it. So after Thanksgiving, I'm going to grade your homework and give it back to you so I can give you feedback. If you have any further questions or comments, you can always let me know. We're going to review the homework one more time more carefully to give, to provide the final answers. And then I'm going to give you a final review or study guide in terms of the topics, questions, problems, the structure of the whole course to make sure that, you can walk away with some useful knowledge, some helpful equipments. Okay? And then we're going to have our final exam. So again, please make sure that this is our final exam time. Please make sure that you don't have any time conflict because that'll be extremely difficult for me to arrange and make up final exam for you after the semester.
Is it going to be in the same building?
Or the same building, yeah, same class, same location. Okay? So please make sure that you don't have any time conflict. That's pretty much our short-term plan. Any questions or comments? I'm gonna send a reminder, hopefully 2 days before the homework due and the final exam also, just to make sure that everyone is on the same page. One more thing, final is not cumulative. You don't have to worry about anything we talk in the first half of the semester. I don't even remember what we covered now, I'm just kidding. So we talked fixed income securities, we talked bank portfolio management, we talked about banks economics, right? The structure of banks' balance sheet, the maturity mismatch. So the first half of the semester is sort of the warm up for all of you. And the second half is definitely down to earth. We're touching base on very important issues. The very last topic here, again, chapter 6 and chapter 7 are very fundamental because we're trying to, walk through the basics, the fundamental thing about financial markets. How do we value financial assets? How do we price them? And how do we understand mispricings or arbitrage activities? Okay. All right, so let's get back to business here in class examples. So we have 2 examples right in chapter 7. How many of you have gone through the questions? At least you've read through the questions. Okay, awesome. So the first question is going to be, the straddle portfolio, we use option contracts, call options, and put options simultaneously to create a portfolio to speculate. Okay. We're not talking about hedging. We're not talking about calculating. We're talking calculating the profit. We care more about the profit in the first question. Okay, so the first question can be, if you're into this kind of stuff, option trading, you can feel free to use this idea to sort of for your own purposes. If you're a day trader, individual investor, you can always use this idea. It can go either way, actually. So in this question, specific question, we'll be talking about a positive trading direction. We buy call options and buy put options all together. We put them all together in one portfolio. The other way around could be we sell call options and sell put options. Or alternatively, we can say that we write put options and write call options all together. So the trading direction is going to be totally opposite. But we're going to talk about that later, okay? So that's the first question. The second question is very useful for big institutional investors, and especially for international banking system. A lot of big institutional investors, they have foreign exposures, for example, in Europe. How do we hedge some unfavorable exchange rate risk, for example? If in this case we don't like the risk associated between the dollar and the British pound, so how do we get rid of that using put option or call option? Okay, so the second question is more about hedging. How do we remove any unnecessary risk or uncertainty using options? So hopefully after we talk about these 2 questions, we're going to be able to cover pretty much everything for speculation, for hedging, and then we don't have that much time to thoroughly talk about all kinds of problems, but hopefully we can generalize this discussion, right, using different portfolios. There is number 4 in the homework assignment is very similar to question 2. If you're interested, after today's discussion, you can start working on number 4. And let me know how you feel. We have 4 big calculation questions in the homework assignment in total. The first one is Fama French 3-factor model calculation, which is similar to one of the in-class examples. The second one is arbitrage pricing theory, so we're going to work through that question all together this coming Tuesday. And the third one is exactly the same as this one. And number 4 is very similar with this one. But instead of call options, we're considering put options. So the logic remains exactly the same. Okay, so hopefully we can work together today to get our hands dirty to walk through these 2 questions. Now let's get started. Okay, so just as a reminder, we talked about the straddle trading portfolio, the straddle portfolio, right? 2 days ago. Can anyone remind us of what we put in there in a straddle portfolio using call options and put options, and how does that portfolio work in different scenarios? Any thoughts?
We buy a call option and put option.
We buy call options and put options, right? And put them all together in one portfolio. So call options give us the right to buy the underlying asset. It can be a stock, it can be foreign exchange, In this case, it's foreign exchange. We're talking about Swiss francs. So the underlying asset can be pretty much anything. The call options give us the right to buy anything, the underlying asset. The put options give us the right to sell it. Okay? So when the strike price is lower than the underlying asset price, we can exercise which part of the portfolio, the calls or the put. When the strike price is lower than the underlying asset price,
That's the call.
it's gonna be the call, right? So we can exercise the call and make profits from exercising the call options and let the put options expire worthlessly. On the other hand, if the strike price turns out to be higher than the underlying asset price, we're gonna exercise the put. So either way, we have a way to make profits. We can, decide or make decisions to exercise either the call options or the put options, and let the other type expire worthlessly. Okay. So in this question, we're dealing with 3 contracts of put options. So basically, we buy 3 contracts of put options, and we buy 6 contracts of call options. Okay, we put 9 contracts altogether. We take long positions on 3 puts and 6 calls. So please keep in mind that we're dealing with a larger number of call options. We're dealing with 6 call options and 3 put options in this portfolio. Okay. The strike price is the same across all different options. It's 65 cents per franc. So basically, there's nothing fancy about it. This is an exchange rate, basically. So we're using 60 cents based on US dollar per franc. Okay, so the 55 cents is the sort of the strike price. We're using this as the benchmark to begin with. And then the contract size is this much. We don't have to care too much about it because it's going to cancel out in the calculation. The put premium, again, we have to pay a price to buy a put option, right? The put premium in this case is 2.5 cents because we're all US dollar based investors. We're counting everything, the profits, the costs, based on the dollar. Okay, so we have to spend 2.5 cents per Swiss franc to buy the put. The premium here is simply the price for put option, right? And then the call premium instead is a little bit cheaper. It's 2 cents per Swiss franc. Okay, so now we pretty much have everything, all the information to do the calculation. So our goal here is to determine when do we make money and how much money can we make depending on the future scenario. Okay, and then eventually we have to make our calculation as accurate as possible and complete the diagram that plots sort of the profit schedule of this portfolio. Okay, so our task here is twofold. The first one is to determine a plot and make that plot or diagram as accurate as possible. And the second task is to calculate sort of the break-even point, like at what price on the future exchange rate or the underlying asset price will break even. So basically, the entire cost of us building this portfolio is equal to the entire profit we'll be making. Okay. All right, so let's get started. So this is pretty much the setting of this question. Now I think we're ready to go. Right? So let's work on this question all together. If you can feel free to take notes because the question is going to be exactly the same as one of the homework questions. Okay, so let me quickly go through what we have so far in terms of the information or the setup. This is question 1, and we're dealing with a positive trading direction. We're dealing with a positive strategy. We buy calls and puts all the time, in the same time. Okay, so more specifically, we buy 3 put options, 3 puts, and we buy 6 calls. So the trading direction is very important. So later on, we can think about another case in which we sell put options and call options. So please keep this in mind. Buy and sell yields totally different results. Okay, but in this case, we buy 3 puts and 6 calls. The strike price is the same across all option contracts. Okay, the strike price, we use capital K to represent the strike price here. It's going to be 65 cents or $0.65 per Swiss franc. Again, there's nothing fancy about this price or the unit of Swiss franc. This is just the price of the underlying asset here. It's just, for example, $185 per Apple share. It's exactly the same idea here, okay? The strike price is $0.65. And then we also know the put premium, so the price we have to pay to buy one contract of put option. So that's gonna be 2.5 cents per franc, right? Or we can write down $0.025 per franc. So this is the price for the put contract. Again, we're buying three of them, right? What, use this number multiplied by 3 to get the total cost of all three put contracts. And then how about the calls? For the call option, we have to pay 2 cents, right? Alternatively, it can be $0.02 per franc. Okay, so everything in this setting, in this question is based on the foreign exchange rate. But we can interpret all of these numbers as the price for the underlying asset. Okay, so these are the two prices for puts and calls. And then we also have a contract size, which does not matter that much. Later on, we'll be able to see how we can use the contract size. So contract size is set at 62,500 francs. So we're dealing with a contract with a size of this much. So that's going to be helpful for us to determine the final sort of calculation in terms of the magnitude of these two options. All right, so how do we sort of start thinking about this problem? Because we're here to plot a diagram, right, of this portfolio schedule. We know that we're gonna, when do we make money? Now we have 3 put options and 6 call options. We put them together in one portfolio. How do we make money? We don't have to care about, the time pattern. We don't have to care about the dynamics. So nothing here is time changing. We only focus on the maturity date, on the very last minute when things turn out to be realized. When the price of or the foreign exchange rate is realized on the maturity date, after the market closes, everything is determined. We'll be able to calculate our profits, right, or revenue from this portfolio. So how do we make money from this sort of straddle portfolio? If the price goes down or up, right or up, exactly. So the price has to change by a lot for us to profit from the whole portfolio. If the price doesn't move that much, we're going to end up losing money. That's exactly true. So based on your logic, we can plot the diagram roughly like this. Then we can sort of take more steps to finalize our diagram, right? We're facing a 2-dimensional world again. The horizontal line here can be the realized foreign exchange rate or the stock price or any asset price of the underlying asset, capital S. Okay, so we're talking about a cross-sectional relationship between the underlying asset price and our portfolio profit. Okay, so nothing here is changing by time. The time is already determined. It's set on the maturity date. Okay, now we're trying to figure out how much profit we'll be making depending on this price. Okay, so the only sort of unknown parameter is the future price on the maturity date. Okay, capital T here represents the final maturity date. So when the 3 puts and 6 calls, they all mature at the same time, how much profit we'll be making. Okay. So based on our discussion earlier, we'll be making money if the price goes down or up by a lot. What could be a good starting point is the strike price here. So for example, we know that the strike price, capital K, you can use capital X, you can use capital E to stand for the exercise price or strike price, anything, any letter would do. Okay, so in this case, we use capital K. It's going to be $0.65 per franc, right? So this is 0.65 can be a good starting point. So what happens if the future price of the underlying asset turns out to be the same as the strike price?
Worst case scenario.
The worst case scenario, exactly. So in this case, we end up losing everything. all our entire upfront investment, right? We paid 2.5 cents per contract to buy 3 put options. We paid 2 cents per contract to buy 6 calls. So altogether, those costs combined is our entire upfront cost, okay? So if the underlying asset in the future, on the maturity date, turns out to be the same as the strike price,
You don't exercise.
we end up losing everything. Because we can't exercise none of the call options and put options. We have to let all the options expire worthlessly.
Oh wait, that's what I
Okay.
said.
So let's, randomly pick a location here. So that's gonna be our entire loss. This is the worst case scenario. This is our max loss. Later on, we'll be able to calculate the magnitude of the max loss here. And then how do we start from here? So this is our worst case scenario. The strike price is definitely something that we would like to see the least. So how about we move slowly to the left side of this picture? What's gonna happen if we move to the left? Which part of the portfolio we're exercising, which part of the portfolio
The
we're
put
letting
options.
go? We're exercising put options, right? No, we're talking about the left side of the picture. That's exactly right. So we're exercising the put option. Now we have three put options, right? We're able to exercise all 3 put options and then make profits from those 3 put options. However, we are suffering the one-time sunk cost, everything combined in terms of the 3 puts and 6 calls. Okay, so that part of the upfront investment is fixed. Is already, we've already paid it. Okay, but it's gonna be random in terms of the amount of profits we can be making from exercising the 3 puts. So how do we plot a line here if we move to the left side of this picture? Is it gonna be linearly related to a lower future price of the underlying asset? So the lower the price is, well, the lower the price turns out to be on the maturity date, the more money we'll be making.
Yeah, so
So
the further it goes left, and okay, go ahead, sorry.
Right, so we can continue to plot something like this. So basically, as we can see, there are kind of 2 interesting things emerge. The first one is we have a break-even point. So basically, this point tells us that our net profit is 0, which means that we're able to exercise the 3 put options and make some money off of it. However, we have to suffer the one-time sunk cost because we purchased 3 puts and 6 calls. So those 2 parts are identical to each other. So the net difference between the 2 parts is going to be 0. And that's why we're breaking even, okay? And the future price turns out to be lower. If that's the case, then we can end up making a higher positive profit, which means that by exercising the 3 put options, we're able to make more money from that.
Does the time value change when you're holding like more puts and calls at the same time?
It's definitely changing. Yeah, it's a good point. Because time value is so hard to estimate. In this case, we're only talking about the maturity date case where time value is already 0. Because when the market clears on the maturity date, so everything's settled, the time value will be 0.
I might be getting ahead here, but so you're gonna do the opposite for the calls, and then at that point you have the inflection point, and that little, I guess that little triangle there
Right.
is wherever, if the price falls in between there, you'll lose money
Right.
plus your initial cost, but outside of those lines is where you'll like make profit,
Exactly,
right?
yes.
Is that how? Okay.
Exactly. Right. So the entire left side of this picture is when we exercise the 3 put options, right, and then make money off, from the 3 put options. Moving from here, how about the right side? It's going to be the other way around, right? We exercise the 6 call options, and then profit from it. However, we still suffer the one-time fixed cost. So how do we plot the right arm of this picture?
Going, yeah,
It's gonna
top
be-
right.
0. Oh.
Top right, right?
Oh.
It's gonna be
Yeah.
sort of a flip version of the left side of this picture. How about the slope of the curve?
Pretty steeper,
It's gonna be steeper. Why is steeper?
because we have 3 times or 2 times more calls.
Exactly, yeah, that's a really good point. So the slope of the curve on the right side is gonna be steeper than the left curve because we are holding a larger number of call options. So the speed of us making money from exercising the call options is gonna be faster. Because we're holding 6 call options, we're only holding 3 put options. If we only exercise the 3 put options, we can make this much money. However, if we exercise 6 call options, we'll be making, theoretically speaking, double the amount, right? So the slope is gonna be slightly steeper, and then we're able to sort of complete the diagram this way. And again, we have another break-even point, okay?
So your margin of error for your puts is higher, right?
Right, exactly. So like roughly speaking, now we're able to sort of, start or initiate this profit diagram. On the left side, we're able to exercise 3 puts. On the right side, we're able to exercise 6 calls. We can make money either way, right? If the price goes down by a lot, below the break-even point A, or the price goes up by a lot beyond the break-even point B here, we're able to make money. So the profit will be positive in this area and this area. If the price does not move that much, we end up losing money. It's gonna be a shaded area in the center. Okay, so this is sort of how we can intuitively interpret the profit schedule. But now let's make it more complete. There are 3 sort of smaller jobs for us to complete. The first one is we're able to calculate the max loss, right? That's the first question. The second question is let's figure out the 2 break-even points. Like at what point in terms of future price we're break even? We're not making or losing any money. Okay. All right. So first question first. How do we calculate the max loss? Any thoughts?
Would you just multiply your calls and your puts and then add those up?
Right. So one way to do it is the max loss. I mean, we know that how many options we purchased already, right? We purchased 3 put options. Let's calculate the max loss here. So max loss is also the entire upfront investment cost, right? How much money we've spent to build this portfolio, or the cost of building this portfolio, okay? So we know that we have purchased 3 put options. How much is the put premium here?
It was 0.025.
Uh,
Oh no, 0.002, yeah.
Right, yes. So that's the put premium for one contract of put option. The unit here is, the dollar against the franc. Okay. And then, so this is for the put. We can worry about the contract size later. So how about the calls? We've purchased 6 call options, right? We can use 6 times the call premium. In this case, the call premium is 0.02 dollars per franc. Okay, we put them together. So this is just based on 1 Swiss franc, like per unit of franc kind of cost. However, we're dealing with a contract size. The contract size in total is going to be 62,500 Swiss francs. So combining or taking into account of the contract size, we can calculate our entire cost of building this portfolio. You can double check my answer here. For buying the 3 put options to sort of fulfill the contract size, we have to spend $4,687.5. So that's our entire upfront cost to buy 3 put options to fulfill this contract size. How about for call options? It's gonna be 6 times 0.02 times the contract size, right? For the entire upfront cost to buy 6 call options in order to fulfill the contract size is going to be 7,500. So there's nothing fancy, it's just pure calculation here. Okay, moving from the first row to the second row here. All right, this is for the puts, 3 puts. This is for 6 calls. So let's keep these 2 numbers as is. We're gonna use these two numbers later on to calculate the break-even points. Okay? In total, we're gonna end up paying $12,187.5. So that is our entire cost to build this portfolio. As we can see, it's not trivial. Building the straddle portfolio, or later on we'll see another case like reverse straddle portfolio, is not trivial. It's very costly. And most of the time, I think the market makers are overpricing, overcharging these call options and put options because they know that we're playing this dirty game. They don't want us to be too profitable. And the market tends to overprice options. So it can be, another layer of cost for us to day trade options. So let's also keep that in mind. So our total cost would be, $12,000 some dollars. In the worst case scenario, if the future price turns out to be the same as the strike price, we end up losing everything, right? The entire $12,000 initial upfront cost. Okay, so now we've completed the first step. This is going to be a minus $12,187.5. This is the worst case scenario, the max loss for us. All right, so let's tackle the two break-even points, A and B. So how about this? Let's work on break-even point A because these two are very complicated to figure out, very hard to walk through. Let's work on break-even point A together, and then if we have any volunteer to walk us through the point B, that would be ideal. Okay, so let's work together on break-even point B. All right, so firstly, let's figure out what happens at break-even point A. What it means is, the future underlying asset price turns out to be exactly the same as a certain break-even point A, which is unknown for now, but we're trying to figure out. So how do we calculate this break-even point A? At this point, we're break-even in terms of the net profit. The net profit for us is 0. So what happens is we exercise the 3 put options, we make money out of it, but we end up losing the entire upfront cost. This is an upfront sunk cost. No matter what happens, we have to pay this premium. We have to pay the price. It means that the profit, in other words, the profit for us to exercise the 3 put options is going to be the same as the max loss or the max costs. Okay, that's how we can sort of figure out the break-even point A. Okay, so let's look at this case first. Break-even point A. Let's figure out the point. We're trying to calculate the point here. So the logic behind the break-even point A is we exercise or we profit from exercising the 3 put options. Okay. But on the other hand, we can't exercise any of the call options. We have to let the 6 call options expire. Right? So those are the sunk costs for us. Okay. The left-hand side of the equation here is the profit from exercising 3 puts. On the right-hand side, we can write down the costs for the 6 call options because we cannot exercise them. Now we're breaking even. The profit equals the cost. The net profit for us is 0. Okay, so this is sort of what happens at the break-even point A. So let's write down a good equation for us to calculate this point A. We know that we have 3 put options, right? So firstly, let's sort of calculate the intrinsic value of exercising the 3 put options. Do we still remember the intrinsic value price function? How do we figure out how much money we make by exercising the put option in this case? Any thoughts? We're comparing the strike price and also the future underlying asset price. In this case, because the break-even point A is on the left side of the strike price, we know that this point A is smaller than the strike price. And that's why we're able to exercise the put option and make money from it, right? So what could be a good intrinsic value for the put option? Any thoughts?
Would it be stock price minus strike price?
It's gonna be the stock price minus strike price. Or if we want to sort of make sure the sign is positive, it's going to be sort of flipped. Right? That's a correct answer. So how about we use the strike price, which is higher, minus the stock price, the underlying asset price on the material. Okay, so that the difference between these 2 numbers is going to be positive. We're able to make some profit. The intrinsic value in this case is positive for the put options. Okay, so that's a really good answer. And then, because we have three put options, right? So this is how much money we make from exercising one contract of put option. But we have three of them. We use 3 times the entire thing. Okay, so that's our profit. How much money we can make from exercising the 3 put options. How about, what do we put on the right side of the model here? We're break even. The profits are going to be equal to the entire costs. We simply use the entire or the max cost to put on the right side of the model here. Okay, we can use $12,187.5. And that's gonna be it. We're missing a little bit, the contract size on the left side to make sure that we're fulfilling the contract, basically. Okay, so we can further multiply the contract size, which is 62,500, and that's it. So as we can see, the logic here is very simple, right? Because we're making money from exercising 3 put options, and on the other hand, we have already paid the entirety of the stock cost. We directly borrowed the number from here. It's going to be $12,000.
So what does the right side represent? That's the.
The right side is actually the cost for 6 calls plus 3 puts.
Okay.
Oh, okay.
It's a little confusing to write down the equation this way because it's sort of the net profit from 3 puts. Or we can modify this equation, the entire cost of 6 call options and 3 puts. If we write down this equation this way, the left side means the intrinsic value. So this is exactly what we're trying to figure out here. That's a good point. The idea here is we're profiting from 3 put options, and the left hand side, the whole multiplication is the entire money, the entire amount of money we can make from exercising 3 put options. On the right side, this is the one-time sum cost that we have to pay to buy the 3 puts and 6 calls. Okay. All right, so we know how much the strike price is. It's 0.65. We're trying to figure out this one. This is our break-even point. This is our break-even point A. Okay, and that's the only unknown parameter in this pricing formula. If you don't mind, if you have your financial calculator, you can sort of get your hands dirty and calculate it. If you have an answer, please let us know. So just make sure that the calculation is accurate. So we can plug in the 0.65 as for the strike price. And then the only unknown parameter is the break-even point A. So once you get an answer, to double check your answer, the break-even point A has to be lower than the strike price because that's located on the left side of the strike price. Okay. Just a quick way to double check the answer here. We can only keep 3 digits, we're not going to keep that many digits, with 3 digits. I think the final answer only has 3 digits, 3 decimal points. We can start with dividing the contract size on both sides, and then we subtract the strike price. And then we have 3 contracts of put options. If you have any answer, please let us know.
Would you mind writing that out?
Yeah, sure. The equation.
Yeah, just write it down.
So it's going to be 3 times 0.65 as the strike price
Mhm.
minus the break-even point A times the contract size and then on the right side of the model here is the entire amount of the sunk cost.
And then you said bring the 62K over to the right side, right?
Right.
Okay. Thank you.
Yeah. Any idea, any answers? Exactly, that's correct. That's correct. 585. So 0.5 double check the answer. Does anyone else have the same answer? Okay, awesome. 0.5585. It means that, this is break-even point A. It's 0.85, sorry, $0.585 per franc. So it means that when the future exchange rate between the dollar and the franc turns out to be 58.5 cents per franc, we're break even. If it goes lower than that, we can start making a positive net profit. If it goes higher than that, and in between, we end up losing money. So our net profit is going to be negative. Okay. So this is a really good starting point because we can double check if our calculation makes sense, because we can write down this number here, $0.585 per franc, which is lower than the strike price, so that makes perfect sense. Okay. Any other thoughts or answers or questions? Okay, awesome. So the lower the price is, the future exchange rate has to be lower than this one for us to make a positive profit. Now we're talking about this area. If we move further to the left, we're able to make higher profit or positive net profit. Okay? The lower it goes, the better off we will be. The more money we will be making. Okay. All right. So this is sort of the main steps for us to think about calculating a break-even point A. How about for B? Any thoughts? Any volunteers? Before we say anything about.
Why did you just do the same thing?
So so at this point what happens is we're exercising part of the portfolio and let the other half of the portfolio expire.
Yeah.
And then we're making money from exercise those options, and we're still suffering the entire amount of fixed cost. So we can make those two identical to each other. Any volunteers? We can walk through. We can briefly say the main logic.
Sir, would you mind working it out, please?
Yeah, sure.
Just to get an idea.
So at this point, what happens? Let me just quickly cover this part. At break-even point B here, what happens is we exercise the 6 call options. Right? We make money from exercising those 6 call options. The profit will be coming from the 6 call options. And we're able to write down a good intrinsic value model to calculate the overall profits. On the right-hand side of the model here, we still suffer the fixed cost, right? The entirety of the fixed cost, which is fixed. The costs of 6 calls and 3 puts.
Yeah, it's a 12,000 number.
How do we write down a good intrinsic model to calculate the profit for the call option here? Any thoughts? So at this break-even point B here, it has to be, the future underlying asset price has to be greater or larger than strike price. That's why we're exercising the 6 call options. To calculate the intrinsic value associated with one contracted call option, we can use a higher future underlying asset price, the break-even point B in this case, minus a lower strike price. Right? So this is our intrinsic value model actually for the call option, for exercising the call option. In this case, this is positive. Right? We end up with a positive intrinsic value, and that's exactly why we're exercising the 6 call options. And then we have 6 contracts of the call options. Okay, we use 6 times the entire thing. And then we can further time the contract size, just to simply fulfill the contract. It's going to be 62,500 Swiss francs. We don't have to worry about the unit. This is the entire profit we can be making from exercising 6 call options. On the right side, it's going to be the entire upfront cost. We can directly borrow the number that we just calculated earlier. So that's going to be $12,187.5. Okay, so this number remains the same across all kinds of different steps. We don't have to change that. now we're done, basically. It's very kind of straight, not super straightforward, but it takes a lot of understanding for us to write down this intrinsic model. Long story short, we profit from the 6 call options. But we have to, the tricky part here is that we have to make sure that the intrinsic value pricing model is correct. In the call option case, we use the underlying asset price in the front. We use that minus the strike price, because this way we end up with something positive. The entire thing inside the parentheses is positive. Right? That's call option case. However, earlier, as we saw, in the put option case, we use the higher strike price up front, minus the break-even point, because this way we can end up with something positive in the parentheses. So we always want to make sure that the intrinsic value is positive. Okay. All right. So now we're basically done, because the strike price is given. We know that it's 0.65. Okay. And then we're here to figure out break-even point B. So we're able to complete this pricing model here. We use 6 units of call options times the entire thing. The only unknown parameter here is the break-even point times the contract size is going to be equal to the entire cost, 12,187.5. Okay. So I did the calculation already. Let me just give you my answer here. You can double check my answer. The break-even point B is 0.683 or 25. We don't have to keep this many decimal points, but the main idea here is it's going to be 68 cents per franc. And this number has to be larger than the strike price, which is 0.65. And that's why we can exercise the 6 call options. So what it means is, at this point, if the future exchange rate between the dollar and the franc turns out to be 68 cents per franc, we're break even. We can't make money. We don't lose money either. The net profit for us is simply 0. The higher the price goes, the more money we'll be making. And if I ask you, what is our max benefit, max profit? What should be the answer here? The max profit. How much is our maximum possible profit from this portfolio? The possible most money we can make. Any thoughts? Theoretically, not in the real world.
Isn't it infinite?
Infinite. It's infinite because, the higher, theoretically, there's no upper bound limit actually for the future underlying asset price to go up. If it keeps going up, which means that the dollar keeps appreciating against the franc, we can make a limited amount of money from exercising the 6 call options. Excuse me. It's going to be infinity. So that's on the right side of this picture. On the left side of the picture, we're able to calculate the max profit as well from exercising the 3 puts. And this part is bounded, right? It's limited, but we're able to calculate it, but we don't have to. Once we figure out break-even points A and B, and also the max loss, we're able to complete the entire diagram. All right. Any questions? Any last round questions or comments or thoughts? Please.
Is this struggle for you? Like really useful in the world? Because it seems like if the market's fluctuating with a reasonable amount,
Yes.
it's up with
Right, that's a good question. It's really useful. It's very useful. Although most likely the call options and put options are overvalued in most cases, this is still really useful. A lot of day traders use straddle portfolios to profit, especially if you think that the market is going to be volatile for a while. You can start reading this straddle portfolio. Yeah. What is the name? Alice. Okay. Yeah. It's a good question. So later on, we'll be able to see a case where there's an arbitrage opportunity, the call options are mispriced. We can sort of take advantage of that as well. So just a quick discussion, then we can take a short break, and then we can talk about the second question, because we're running out of time, I think. So this is a straddle portfolio, right? In this case, we buy call options and put options all together, right? We put everything in one portfolio, we're taking long positions. We buy everything, all the option contracts. What about we sell call options and sell put options simultaneously? How do we change the dynamic here? For now, let's not worry about the number of the contracts. So what about we just sell one contract of call, one contract of put? We sell both together. So how do we change the dynamic? Any thoughts? This is a tricky question.
But how, if you're selling it, how can you have, I guess, the break even, like the break even points, like would they matter? If you're just
They still matter.
They still?
They still matter. If we sell call options and put options, we basically flip this whole thing
Oh, Jesus.
upside down. Because, by selling call options and put options, we're trading with our counterparty. So our counterparty will be facing exactly something like this. And that's their profit schedule. The amount of money they're making is gonna be our loss. And then by selling call options and put options, we're able to collect those premiums upfront. So that's gonna be our upfront profit, right? It's gonna be our upfront profit. And then the reverse straddle is gonna be something that looks like this. Okay, so we're benefiting from a less volatile market if the future stock price does not move that much. We'll be able to make a positive profit. But if it moves up a lot, then our counterparty is going to exercise either the call options or put options, and they're going to benefit from it. We're going to end up losing money. So this is entirely a zero-sum game right here. Okay. So this is the case of, let me write it down here: selling or writing call options and put options. Calls and put.
So the ones who sell the contract or the option contracts, are they the ones that also pay out? If the call does end up being positive, does the person that sells them the option pay out to them?
So, sorry, I don't think I.
You said there was they would sell it on there, but if their option proves positive and it does go either way in their favor, you said you take on that loss. What loss?
Right. No, but it's on the maturity. So everything has to be settled. Like we have to deliver the underlying shares. So everything here is being discussed on the maturity date after the market clears. We're not talking about selling or buying options before the maturity date.
Oh.
This is everything on the maturity date, like in the very last minute
Okay.
after the market clears. We're able to figure out how much of the profit we can be making and losing.
And the option holders, do they have the shares? Like with them all, like people that sell them, do they already have the shares like on hand?
If you're intending to deliver the underlying asset, you have to have the shares.
Okay.
Yeah. Especially your selling put options. Yeah. It's a good question. Any other questions or thoughts?
Wait, so just to make sure, for it to be inversed, you have to hold the shares first,
Right.
and it's like a covered collar like that.
Right.
Okay.
Yeah. So if you have, for example, 100 shares of Apple stocks, you're able to write any call options or put options, just one contract. You're able to write calls and puts written on Apple stocks. But in the real world, you have to apply for access to trading options based on your trading experience. But that shouldn't be too complicated. But it's sort of another layer of application. Any thoughts or questions before we move on to second one? Okay, so how about we take a short break and then we can talk about number 2. Yeah. Yeah, sure, yes. So, yeah, this is the key, I think.
Yeah, that's what it is.
To the switch, yeah.
Yeah, so can I just remove it?
I think so.
Yeah.
Or you can write it down for the questions.
The question?
Yeah.
So I can just put like calls and
Right, so this one will be for
calls
calls.
and I
I just want a simple a crypto run. It'll be good, you know.
Crypto?
You know, like scam people.
Like what's it called? Crypto Zoo?
Yeah. Look, guys, and it's really easy too. All you gotta do is use buzzwords. It has blockchain technology. Gas fees are low.
Gas. What does that mean?
It's just the amount of energy it uses to make the transaction, which is very small, but sometimes the fees can be enormous. And also to prove my my project's legit, I'm gonna have a pretty lady.
Dude, you're an engineer, right?
Walk through the second question.
Dude, there's so many finance people trying to hire engineers. It's kind of crazy.
The second question's logic is very different.
Right.
Is very different from the first one because you know in the second question we're only talking about planning. Okay, we don't care about the profit. For the first question, it's all about profits. Right? We're building a profit straddle portfolio to make money off of it. However, in the second question, so the story flow here is in the second question. Let me start repeat. So here's the story. As a U.S.-based investor, we're counting every dollar on the basis of the dollar, right? So we start off with the U.S.-based investment. We convert it to, we're interested in UK pound-based security, bond security, fixed income security, okay? So we firstly spend the dollar to convert it to the pound. In the UK, for example, we spend 900 some pounds to buy one unit of bond security. So that security is gonna pay us 1,000 pounds when it matures. So we're gonna be able to collect those 1,000 pounds from our investment, and this is a done deal. This is written in the contract. Okay, so we know that we're able to collect this 1,000 pounds, but what's not known for us is that because we're a US-based investor, we're going to convert this 1,000 pounds on a future date back to the dollar. And the future foreign exchange rate between the dollar and the pound is unknown. So for example, if it turns out to be 1.4, we're able to convert it to how many dollars? $1,400, right? With 1,000 pounds. If it becomes 1.5, we'll be able to collect $1,500 using this 1,000 pounds. Okay, so the story flows like this. Up to this point, everything is settled. It's happened today. We made the investment. We know that we're going to be able to collect 1,000 pounds exactly. Nothing will ever change. It's a done deal. It's predetermined in the contract. However, what is risky here is that when we're converting the 1,000 pounds back to the dollar, we don't know how much dollar we'll be able to convert it to. Okay, so we want to sort of hedge against the foreign exchange risk on a future date. For example, what if the bond security is maturing in 1 year? We don't know what's gonna happen in the foreign exchange market in 1 year, right? So this is either way, you know, it's sort of risky. It's a huge uncertainty associated with. So this is the whole story for. Like, the question here, how do we use an option, put option, call option, to help us achieve the hedging purposes? So that's the main question here. Okay, so I don't think we have enough time to read through the question. If you're interested, I mean, if you have, that would be ideal. But you know, let me just quickly give you the setup of this question. All the information. We're dealing with call options. We're thinking about using call options to achieve the hedging purposes. Okay. This is, you know, two possible scenarios. On a future date, for example, in 1 year, the exchange rate turns out to be $1.4 per pound or $1.5 per pound. We're dealing with these two possible scenarios. In other words, we're simplifying the whole world a little bit. We're not considering, you know, thousands of different possibilities. We only consider two possible scenarios here. We're using call options to remove any sort of, you know, exchange rate risk in this case. Okay. So the call options on the pound has a strike price. We still use capital K to represent the strike price. The strike price is very, very interesting. It's $1.3 per pound. On a future date, we're assuming that it can be either 1.4 or 1.5. It means that the pound is going to appreciate against the dollar. We have to spend a larger number of dollars to buy 1 unit of pound. Okay, but this is uncertain. We don't know what's going to happen in 1 year. Okay, but the strike price is settled. It's 1.3. The current spot market in the exchange rate means that it's today's price. We have to spend $1.32 to buy 1 unit of pound. There's nothing fancy about this number. We just simply, you know, use this as a conversion rate between the two currencies. This is extremely helpful, useful in the international banking system. Barclays is doing that on a daily basis. JP Morgan, Bank of America also. They're intensively using this kind of portfolio to hedge against foreign exchange risk and many other kind of similar risks as well. Okay. And then on a future date, in 1 year, when the bond security matures, we're not sure whether the future exchange rate in 1 year is going to be 1.4 or 1.5. So this is the risk source. This is the uncertainty here. Okay. All right, I think we're good to go because we know pretty much everything. We have made the investment. We've purchased the pound already. We know that it's going to pay us 1,000 pounds in 1 year when it matures. Let's use a scenario analysis kind of table to represent the idea. We know that the future exchange rate can be $1.5 per pound or $1.5 per pound. So this is the two possible scenarios. And then the UK bond is going to pay us 1,000 pounds. Right? If the exchange rate turns out to be $1.4 per pound, how much dollars are we going to be able to collect from the 1,000 pounds if it's in the first possible scenario? Because we have to convert everything, that 1,000 pounds back to the dollar. We're able to collect $1,400. Once we receive 1,000 pounds, we can convert it, you know, spot exchange market using this future spot exchange rate. 1.4. 1 pound is worth $1.4. Now we have 1,000 pounds. We're able to convert it to $1,400. Okay, so that's in the first case scenario. How about in the second case scenario when the price is 1.5? We're able to collect $1,500 in this case. As we can see, the payoff is different. It depends on the scenario. That's a risk source. We're not sure how much money we'll get eventually. Okay. Now we're thinking about using a call option or a certain number of call options to deal with this situation. The call option has a strike price is $1.3 per pound. Okay, so in the first possible scenario, what is the payoff? Do we want to exercise a call for now? If we have purchased 1 unit of call option in this case, the strike price is 1.3. The future scenario or the future exchange rate is 1.4. If we exercise the call option, we're able to spend just $1.3 to get 1 unit of pound. When the current price is more expensive, we never want to exercise the call, right? So once we exercise the call, how much money can we make? The contract size here is $1,000, 1,000 pounds.
So 1,300.
It's gonna be the difference between the current spot exchange rate minus the strike price. Right, 100, exactly, yes. So it's gonna be 1.4 minus 1.3 times the 1,000 pound basis, okay? It's gonna be $100. So by exercising one call contract, we're able to make $100. And then we don't know how many call options we want to buy. Let's put an X to represent the number of units, or the number of call options for now. We're able to figure it out later, okay? So how about in the second case scenario, how much money can we make? Now the price is even higher.
So
1.5.
200.
It's gonna be 200, right? $200 from exercising one call contract, and we still don't know how many call options we want to be units. Okay, so these are sort of, the only unknown parameter is the X here. And then we have, I think we have enough information to proceed. So the main idea here is that we're trying to build a hedged portfolio that gives us a constant payoff no matter what happens in the future. So any risk can be hedged away. For example, the main idea here can be summarized by a pricing model here. Okay, so now we're thinking about, we have already had one contract of bond security, one UK-based bond in the portfolio. We're thinking about buying or selling some call options and combine that in the portfolio. In the portfolio, we have two asset classes, right? One UK bond and some sort of call options. To achieve that goal, that portfolio is going to, once the number of call options is determined, we're going to get the constant or fixed payoff from that portfolio. And that portfolio will be hedged. Okay, so the main idea here is that in the first case scenario, we're able to get $1,400 from the bond payoff. And then we're able to make X number of call options times $100. So this is the entire payoff of our portfolio in the first case scenario, where the foreign exchange rate turns out to be 1.4. Okay, so how about in the second case scenario? We're able to collect $1,500 plus X times
100.
$200. This is the entire payoff from our portfolio in the second possible scenario. And what should be a good relationship between these two? If we're talking a hedged portfolio, the portfolio is going to constantly give us the same payoff no matter what happens in the future. It's going to be equal to each other, right? Identical to each other. So the main story here is that no matter what happens, if we're in the first scenario or the second scenario, it doesn't matter. Our entire portfolio is going to give us the exact same payoff. So we're hedged. We don't have to worry about, the exchange rate on a future date. And the only unknown parameter here, that's a good thing, the only unknown parameter here is the X. And we're able to solve for that. Okay. So you can double check my answer. I don't think we have enough time. My answer here is, you can double check my answer. X is -1. What is this -1? We sell a call contract, right? It means that we want to sell a call. Okay, so now we've completed the hedge portfolio. So the story here is that we have already bought one contract with bond security, and that's going to give us a constant payout of 1,000 pounds. And then we want to sell the call option, reading on the pound. Now we can combine the two positions in one portfolio, and that portfolio is going to give us a constant payoff. And that hedged portfolio's value is going to be 1,400 minus 100. It's going to give us $1,300 in the first case scenario. And how about in the second case scenario? It's going to be 1,500 minus 200. It's still $1,300. So it means that if we build a portfolio like this, buy a UK bond and sell 1 unit of call option, we're gonna end up with $1,300, no matter what happens. We're perfectly hedged. Okay. And then the only other parameter is the number of call options you want to be dealing with. So that's sort of the entire story.
What does the HP stand for?
The HP is hedged portfolio. Hedged portfolio. So again, in this case, we don't care too much about the profit. We only care about the hedging purposes. You may wonder, we'll end up with less amount of money if we don't hedge. But we never know. Things can go, the other way around. What if the exchange rate comes out of the
For stocks and for currencies are the same, but it's still 100 shares.
Yeah.
All right, so hope I'll see you this coming Tuesday. We're going to talk about the four core problems. And then if you have any questions,